Welcome to Catalyst. I'm Madison Mills. 30 minutes into your U.S. trading day, let's get you the three catalysts we're watching this hour. First up, we'll break down the trading day action as investors brace for $20 trillion worth of earnings results this week. Details ahead. We'll also bring you the latest updates in the U.S.-China trade war and where tariffs stand, as China says no trade talks are underway. And speaking of China, we'll break down Apple's results and what we can expect. That'll be next. Half an hour into the start of U.S. trading, let's get a check on the markets here. Taking a look at the major averages. Still, actually, we're now seeing a little bit more weakness coming in here. You got your S&P off nearly 0.2%. Your tech-heavy NASDAQ off about 0.5%, coming off a week of strong gains. You actually had the Round the Hill Mag 7 ETF having one of its best weeks ever off the back of potential relief around some tariff news, though no actual headlines of negotiations. Let's flip it over, though, to the bond market. The bond market starting to do what it's supposed to amid the volatility over the course of the last 2 weeks. But you can see here your 10-year taken up just a bit by a basis point, your 30-year down about 2 basis points there. And finally, let's take a look at Bitcoin because it had been holding above that 95,000 level right after the market opened. And now you can see a little bit of declines kicking in there, perhaps a touch of a risk-off mentality heading into a very busy week of big tech earnings and economic data to come. To break it all down, I want to bring in friend of the show, Callie Cox. She is Ritholtz Wealth Management's chief market strategist and author of the newsletter Optimistic Callie, and she joins me for the next hour. Callie, it's great to have you on this morning. I'm so excited to get all of your insights, but I do want to start with you specifically on tech, because in our prep call for the show, you said something that I couldn't stop thinking about all weekend. You were on my mind. The impact of tariffs on the tech sector, that could potentially be the biggest loser amid the trade war. Talk to me about how you're thinking about that impact.
Yeah, well, this has been weighing on my mind too. But, you know, the tech sector has been the lion's share of this bull market, right? We all saw 2023 and 2024 massive gains in the Magnificent Seven. And there are really high expectations for tech this year as well. But as you just said, Maddie, tech is also one of the biggest losers from this tariff war in terms of cost of goods sold and in terms of international revenue exposure. We just haven't seen that baked into expectations. And from where I sit, high expectations, low reality is probably one of the toughest spots to be in if you're an investor.
You think earnings estimates are still too high for these tech names this quarter?
Well, I think it's tricky because this quarter, obviously, we had a lot of tariff headlines. We didn't see the reciprocal tariffs until April. So I'm looking more at 2025. 2025 expectations for profit growth in the tech sector sit around 25%. That is a blowout year. And a lot of that sits within the semiconductor space. And semiconductor companies are one of the most exposed industries right now to the tariff wars.
And what might it take for there to be a big tech recovery? Because something that we talked about a lot in the last hour was that the things that make you go down are typically the things that help you get back up again. So we're really relying on those tech names to get us back up.
Yeah, and one thing that makes me feel a little bit better, even though it's been uncomfortable, is that tech has led this leg lower. So expectations in the market have come down. Maybe they're a little bit higher on Wall Street, but investors are already baking in this moderation in the future. You know, what makes it go back up? I think ultimately it's sentiment. If you're looking over days and weeks, if you get a good tariff headline, obviously we saw last week that we saw a little bit of walking back in tariff plans, and the NASDAQ was one of the best performers. So if you're one of those traders that is looking over days and weeks, then it's sentiment. If you're one of those investors looking over months and potentially years ahead, it's probably some change in these plans for tariffs, some confirmation of the AI story, and really a look at demand, demand that we see on the CPU side and on the really just the AI side, since that seems to be the story for big tech right now.
And is that demand story the one to watch this earnings cycle? As if you are an investor who's specifically looking at how much tech will be dinged by tariffs, what is the data point to look at?
Yeah, that's a really good question. I would look at cost of goods sold first. I think international revenue is still very important, especially for the Apples of the world, which I know we'll be talking about. I mean, a lot of global iPhone demand to consider there. I would look at, I'll say this, I'd look at revenue on the product side, on the individual product side, especially when it comes to iPhones, and I would look at the costs that these companies are bringing on, because I think you see that impact potentially a little bit quicker than revenue.
All right, Callie, great overview. Thank you so much. Glad we'll have you for the rest of the hour for more unbeatable context like that. Really appreciate it, Callie. Let's talk about the dollar, because the dollar is ticking higher today, but has weakened significantly so far this year. With earnings season coming into full swing, how much of an effect can we expect the weakening dollar to have on companies? Joining us now, we've got Christian Lawrence. He is Rabobank's senior cross-asset macro strategist. Christian, it's great to have you this morning. Talk to me about which companies might stand to benefit from a weaker dollar this earnings cycle.
It's great to be here. And certainly, that dollar story has, I think, a little bit further to run. And we're seeing a little bit of strength today, but I think that's really month-end flows. Now, when you look at the impact on the corporate world, it is, of course, those that are more externally focused that are going to be most vulnerable to these moves that we're seeing. I think when you're thinking about the tariff story in general, we can divide the corporate world into those that are more domestically focused and those that are more international in nature. And that's likely to come out in the earnings data that we see coming up from not just the first quarter, but throughout this year.
One thing I've been hearing a lot is that the dividend-paying stocks tend to benefit from that weaker dollar. To what extent do you think that that is a big enough lift for some of those names versus just, sure, it's a cherry, but it's not really going to change the story?
Yeah, I mean, I think in general that the dollar story isn't going to be the main driver of earnings at this juncture, right? We're seeing huge shifts when it comes to consumer confidence. That's likely to play out in terms of those consumer companies, I think, are going to be the real focus of earnings season, simply because that is the more forward-looking indicator as to how the tariff are going to impact the growth story of the US, because that's one thing we need to keep in mind constantly, and that is that the US is a consumer-driven economy, and what the consumer does is really the fate of economic growth going forward.
Mm-hmm. Yeah, that's true. And I think that that's a great point, too, considering that international markets have a different sector makeup. I think people forget all the time that, the biggest sector in the European markets is banks. It's not tech, even though tech dominates our lives over here. So, Christian, I have a question on on like a more major asset allocation perspective, because one thing that we think a lot about at Ritholtz is how to prepare our investors for an environment where U.S. exceptionalism is fading, very, very slowly, but still, a trend to watch. How quickly do you see this happening? What are you seeing in your world in terms of demand for U.S. assets and where it's going?
Yeah, I mean, I think that's the top question at the moment, right? And I think there's a few elements here, and I think there are a few misreads that we're seeing. So when we talk about the unwind of the dollar trade, we need to remember that it was such a consensus trade for so long, and this legacy position is starting to unwind, and it probably does have further to go. But we're coming from extremes. I think the other story is, of course, when you think about currencies, it's always a relative story. And what we've seen in Europe is a huge shift, taking off the fiscal brakes, a huge surge in spending that resulted in this mass repricing of the euro. So it makes sense that we're seeing a little bit of dollar weakness. Now, the idea of US exceptionalism fading, that certainly seems to be the narrative at the moment. But I do think we need to bear in mind that moving away from the dollar is not something that the world can do in the short term. It's not something that can happen easily. Yes, we may be seeing policies in place that are encouraging countries to look elsewhere, but it is so deeply ingrained. When you look at demand for dollars outside of the US, it's around 10 times the availability of dollars, and it's still the lifeblood of finance, the lifeblood of trade. So while, yes, we are seeing a bit of weakness, we're seeing correlations in US assets, whether it's equities and the US dollar have increased and gone back into positive territory, yes, we can continue to see this for a bit, but this is not the death of the dollar, not by a long stretch.
Do you feel the same way about the bond market in the States?
I mean, I think the bond market, we are in an environment now where there are essentially a huge range of stackable binary geopolitical outcomes that have wildly variant implications from a macroeconomic standpoint. And to be blunt, it makes median forecasting almost pointless right now. We have to look at these different scenarios and judge how we're veering between them. And I think that's the environment we're in. I think what is really interesting, though, and does fit with that fading of exceptionalism story, though, is when you look at baskets of how currencies have performed. No surprise, because of euro strength, we've tended to see Eastern European currencies perform well, but we've also seen the yen and the Swiss franc perform well, those typical safe havens, and the dollar has not been in that bucket this year. So that's the real breakdown in that correlation that I think is particularly interesting.
Yeah, so I'm a Fed nerd. I think about this a lot, but how do interest rates and monetary policy work in here? A lot of central banks across the world are cutting rates. The Fed is obviously on hold, and we'll probably need to see some kind of actual weakness in the data to make a move. So how do we see that divergence coming through in the currency market, and how do you prepare your portfolio for that?
Yeah, and I think, look, when we talk about the Fed, I think the market has got ahead of its skis a little bit. We've got about 3.5 cuts priced in by the end of the year. And yes, we can see a negative growth environment. We can see a higher inflation environment. Stagflation is, of course, the very big fear at the moment, and that's a very difficult environment for the Fed to navigate. But I think it's important to note, when we say there's 3.5 cuts priced in, that means really it disguises a lot of differing views below the surface. There are some that are pricing in for essentially cutting rates almost down to zero, and some that are expecting no cuts at all. So we need to be aware that that's just the average of the views. And because of these stackable binary events I mentioned, the truth is a much wider scenario. Now, my base case is that the Fed isn't able to cut that much, and we're more likely to see a very cautious approach, as you just alluded to. When you talk about the longer end of the curve, though, this is just going to be whipping around something ridiculous, because we have term premium being built in, then we have lower growth expectations. I think we can see the 10-year at 4% and 4.6% within the pace of a few weeks, quite frankly.
I saw that in your note, and I wanted to ask you about that. Like, can you pick one? Like, which one do you think is more likely, a lower 10-year or a higher one? And to the point of when the Fed might cut, if at all, does that not require a slowness that investors also wouldn't like, that is potentially indicative of a recession? And that makes me wonder if you are seeing recessionary activity in any of the assets that you're tracking.
Yeah, I mean, that's the question, right? Because what have I told you? It might go up and it might go down, which isn't that helpful. I mean, look, my bias is it is this battle between term premium because of the uncertainty, but also these diminishing growth expectations. Now, I do tend to think it is going to be this wild ride. So in the short term, I think 10-year yields, we can see a little bit more upside. But when we start pushing further out and we start to see the consumer sentiment data turn into weaker actual data, that's when we can see a little bit more pressure on the long end.
And one more to kind of put a bow on this. You mentioned a couple times kind of these traditional correlations breaking down between asset classes. What's the trade that can initiate as a proper hedge? Is there something investors can be doing to profit off of that dislocation that we're seeing?
Yes, but it's about being opportunistic. It's about being nimble. If you're a long-term investor in this environment, you can't try and play these sort of breakdowns and returns in correlations. You do have to take a much longer-term approach. So I think it's only really relevant for those fast money accounts that are able to be so active. And it's a question of just jumping on the momentum. But once you've got some profits, take those profits off the board. You can't be greedy in this environment, and trying to hold a position for 1 or 2 months is particularly difficult.
Yeah, have a plan and stick to it. Thank you so much, Christian. Really appreciate you joining us. And of course, our thanks to Callie Cox for joining the conversation as well. We're going to have all of your markets action ahead, so stick around. You're watching Catalysts. It's now time for some of today's trending tickers. This morning, we're watching PDD, Tesla, and Merck KGaA. First up, Pinduoduo, the parent company of online retailer Temu. The Chinese retailer now passing on nearly all of President Trump's new import taxes to U.S. consumers, more than doubling the cost of some products. Shipments of goods worth less than $800 were previously exempt from tariffs under the de minimis rule. They will now face a 120% tariff or a flat $100 fee per postal item starting on May 2nd. Callie Cox is still here with us to discuss. It's really interesting, Callie, when you take a look at the numbers here, some of these items doubling in cost on Temu, and also Pinduoduo competitor Shein having some items go up by as much as 377%. Obviously, these items were already very affordable, so these increases, the percent sounds higher than the end number is, but just wanted to get your take on how that impacts consumer sentiment when there are price hikes like that.
Yeah, well, we're feeling it, right? These reciprocal tariffs that markets have been freaking out for a while are finally making their way to our wallets. And I think that could be a shock for consumers, even though to a certain extent consumers are expecting higher inflation. We've seen that in surveys for months now. You know, what shocks me is hearing, the Fed does this on the ground research. It's called the Beige Book. The Beige Book actually came out last week, but that was one of the first indications of data that we had on if companies are passing along tariffs. And it said many companies are planning to pass them along, which was a shock to me because I think consumers' ability to take them on is a question mark right now.
It certainly is, and China seems more willing to put up with any economic challenges to their own consumers as well, which perhaps will impact negotiations moving forward. But we do want to get to Tesla raising prices in Canada and pushing its pre-tariff inventory as well. The automaker encouraging buyers in the country to purchase cars imported before Canada's reciprocal tariffs on U.S.-made vehicles were imposed. You can see Tesla shares up along with the broader market right now, up nearly 1%. We were talking, Callie, about how exposed Tesla is to the impact of tariffs, and how are you thinking about both that and the broader auto sector's exposure?
Well, automakers are one of the biggest industries exposed to global suppliers. Tesla definitely up there. 80% of its suppliers are outside of the U.S., so that's something to watch, especially if you're a consumer discretionary investor. Tesla is a consumer discretionary stock. We think of it as a tech stock, but that's not what it is.
Right, exactly. And it's interesting to see when you have moves in consumer discretionary, you have to check to make sure whether or not it's Tesla or the entire basket, because it's such a big chunk of it. We're also going to talk about German drug company Merck KGaA agreeing to buy U.S. biotech firm SpringWorks Therapeutics for about $3.9 billion. The German company is saying the deal seeks to strengthen its healthcare segment and expand its presence in the U.S. The transaction is expected to close in the second half of this year. You can see those shares listed over in Denmark, up 1.7%. Now, it's interesting. Obviously, this is happening outside of the United States here, but I wonder how you're thinking about deal making more broadly, because the trade war is impacting countries around the globe, and yet we're still seeing some news of deal making. How are you thinking about the kind of path forward for that?
Yeah, every headline we get for deal making, I love to see it. It's a sign of business confidence. It's a sign that, these interest rates are a little, of course, this is global, right? But, globally, financing is a little bit easier to swallow. Deal making is a good sign in this environment. It's encouraging.
All right, Callie, thank you so much. And also for our audience, you can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. We're going to send it on over to our own Jared Blickery for today's Stocks in Translation. Hey, Jared.
Market volatility is down. Tech stocks are coming off their second best week since 2022. But let's zoom out and look at how stocks and bonds have performed relative to each other since the very first days of the United States over 200 years ago. I'm Jared Blickery, host of Stocks in Translation. And if we're going to compare stocks to bonds, we need to define something called the equity premium. And we're going to do that right here. The equity premium, or stock premium, is the extra return that stocks provide over safe bonds, rewarding investors for taking on greater risk. And by safe bonds, we're talking about generally government bonds, and in the U.S., those are U.S. government bonds, the benchmark for the entire world in terms of safety. And now I want to get to our beautiful chart of the day. This goes back all the way to the early 1800s, and it's based off data that actually begins in 1793, the very first days of the Constitution. And this is stocks versus bonds adjusted for inflation over a rolling 20-year period. And you can see over the time period, in the very early days here, we have a negative value. That means that bonds were actually doing better than stocks. But then stocks took over, and basically for the last 200 years or so, a little bit less than that, we have seen stocks outperforming bonds over these 20-year rolling periods. And I think it's notable that if we want to do a little bit more technical analysis, which I like to do here, we see a breakout of this long-term downtrend in this relationship. So that might mean that going forward, we would expect stocks to outperform bonds. And what also adds to this information, some additional information that adds to this point, is the 10-year T-note yield going all the way back to the late 1980s. And in fact, this trend actually began in the early 1980s. This just shows a very steep downward trend that has been broken out of in the last few years. And when that happened, and let's see if I can circle that down here, that kind of marked a sea change in the markets. That was a new trend that we've seen develop here. And going forward, we might see it come down a little bit. And let's remember that yields move inversely with the price of bonds, but we might not expect bonds to do as well in the coming months and years if this is in fact a secular trend change. So this kind of casts some shade, casts some doubts on the 60-40 portfolio as we've been experiencing it for the last 40 years. Just a little food for thought there. So tune into Stocks in Translation for more jargon-busting deep dives. New episodes on Tuesdays and Thursdays on Yahoo Finance's website or wherever you find your podcast. Maddie?
All right, Jared, thank you so much. Appreciate it. Coming up, after hitting a 4-month low in April, what is crude oil's next big catalyst? We're going to discuss that and more next. Oil prices were little changed on Monday as investors weighed an uncertain trade backdrop between the U.S. and China, along with an upcoming OPEC Plus meeting. Here to discuss what's next in the near term for oil, we've got Eric Lee, Citi's global energy strategist. Eric, great to have you in studio with us. So I know that a little bit more long term, you do expect there to potentially be a rebound, but in the short term, how much more bearishness are you anticipating?
Yeah, sure. Thank you. I mean, we continue to have a view where we could see $60 Brent again in the coming short term, this quarter, but potentially also through to the end of the year. So our outlook, for the rest of the year on average is somewhere around $60, $62, the low 60s. So we continue to see the broader bearish sentiment continue to play out. And there's a lot of things that we continue to need to see play out. What are the effects of the tariffs going to be? How does that filter through to oil demand? And then also, what will OPEC Plus do? Are they going to keep bringing oil back on? And they're bringing quite a bit on in May.
And how are you thinking about policy in the midst of this, particularly given the Trump administration's interest in keeping the price of oil low? To what extent does that inform your view?
Yeah, that's a very core part of our view. So when we think about some of the core interests of the administration, one of them we think is getting oil prices down with the belief that this will get energy costs down and inflation down, and then perhaps even interest rates. Now, the pass-through may not be that simple, but we do believe that they believe that. And so we do think that that's an important consideration. And it does mean it might affect how they do geopolitical deal-making with Russia, Ukraine, Iran, Venezuela, but also just broader policy. Are they going to try to support the US oil and gas sector to try to incrementally help production be higher than it otherwise would be?
Sure. Yeah, and I want to draw out this connection a little bit more between the price of oil and the economy, because from where I sit as a risk manager, thinking about how it affects our portfolios, my mind always goes back to economic growth, right? So when you're looking at the price of Brent oil, is there a price level or a certain signal that would make you say, we're seeing lower demand really start to weigh on oil prices right now?
Yeah, sure. I mean, it's always going to be so many factors at once, especially in this current market, but demand is so core. And I think that's what drove the big sell-off post-April 2nd, right? The fact that we were going to see pretty big tariffs and that they might be quite sticky. That drove Brent from what had been about $75 in the days just before that to where we are now, 66-ish, right? And we've, of course, last 2 weeks, we saw like $59 oil. So that in some sense has already happened, but there's more that can come. If you do get recessions, prices can fall lower, and they find support at some sense of where marginal costs can be.
And what does that scenario do to some of these oil companies, especially if they're already seeing prices hit your levels of $60 a barrel? To what extent is that going to cause significant pain?
Well, certainly it will mean that any higher cost projects that do cost $60 or above, $55 or above, start to be eased down. So, we can see some capex reductions in the US, rig counts can come down. On the other hand, there are still a lot of projects that are ongoing in the US and around the world that cost below that, right? $40, $50, $60 to break even. Those should continue. But again, we should see some reduction activity if we're at these levels, if we move to 60, if we move to 55.
And I wonder, too, you mentioned the geopolitical, so I want to go there, especially given that President Trump met with Vladimir Zelensky again over the weekend. How are you thinking about the impact of any kind of potential ceasefire? Is that something that your folks on your team are telling you there is actually a real possibility of this year, and how does that impact where commodities head?
It's really crucial for oil in particular, but also for some other commodities. Natural gas particularly is very impacted by Russia, Ukraine, and what might happen there. But for oil, they're very important. So the fact that we do have a sense that perhaps there's a reasonable probability that some sort of deal could be done, and that could affect, it could increase some oil supply, reconfigure trade flows for oil, maybe bring back some natural gas, but it's still pretty uncertain. And similarly for the Iran ongoing process and talks, that's also pretty important as well.
Right.
And there, at least, perhaps the pace of those talks have been going a little more quickly than with Russia and Ukraine.
Talk to me a little bit about the incentives that OPEC Plus is looking at when it comes to production cuts and supply at the moment. Because I feel like, at least as somebody sitting on the outside of the oil space, I feel like there are always expectations heading into OPEC and then they surprise us. Or maybe I just hear about that more. But what are you considering and watching here when you think about what OPEC could do at the May meeting?
Yeah, and they have surprised recently. So the last surprise was at the beginning of April. They said they'd bring back 3 months worth of supply in May. So as we enter May, this month should see potentially a bit more of a slug of supply from OPEC+. At the same time, they're trying to clamp down on Kazakhstan and some other producers that have overproduced their quotas for various reasons. But there is a good amount of uncertainty. So on one level, some might say OPEC+ might be really worried about lower prices. So in order to defend those lower prices in a weak economic environment, they might pause the cuts. I think that's a possibility. On the other hand, there are some differing views within OPEC+. I think some countries with quite a lot of production capacity that they might be more eager to bring back sooner. They might be pressing for, let's keep this unwind going. And countries like that might be like the UAE, but even maybe countries like Iraq, Kazakhstan as well.
Eric, thank you so much. Amazing overview as always. Really appreciate your time. Thank you. Coming up, we're going to break down the latest state of trade policy, how it's impacting the chip makers specifically, much more on Catalyst ahead. Stick around. President Trump's tariff blitz in effect for nearly a month, roiling Washington and Wall Street. He's imposed several tariffs on different countries and across different sectors, all within his first 100 days in office. I'm here with my Morning Brief co-host, Brad Smith, and we're going to break it all down, including where it stands today.
That's right, Maddie. And so a 10% universal tariff is in place on imports into the United States effective April 5th, 2025. So countries like the UK, Australia, and Brazil, among many others, are affected here. Meantime, tariffs on Canada and Mexico, they stand at 25% for tariffs that do not comply with the United States-Mexico-Canada agreement. Goods that are compliant, including most energy products like oil and natural gas, can be imported tariff-free. But there is a 10% tariff on non-USMCA compliant energy products. But the biggest tariffs here, the ones on China, which as of April 9th stand at a rate of 145%, the first 20% of which are fentanyl related. And Trump added another 125% after China retaliated with its own tariffs.
That's right, and President Trump also has tariffs in place for certain business sectors as well. Let's get you some examples. Effective since March 12th, there are 25% tariffs on all steel and aluminum imports. Then effective since April 2nd, there are those 25% tariffs on Venezuelan oil imports, as any country that directly imports Venezuelan oil as well. And finally, effective since April 3rd, there are 25% tariffs on all automobile parts. 25% tariffs on auto parts are scheduled to take effect by May 3rd.
That's right. Well, the president also imposed additional reciprocal tariffs on a number of nations meant to reflect trade imbalances. However, Trump paused these tariffs on April 9th for a 90-day period as nations enter into negotiations with the U.S. Amid this trade uncertainty, the S&P 500 is down 6% since the start of the year.
Let's take a look now at shares of Nvidia, if we've got them. Shares of Nvidia are down a little over 2% after news that Chinese company Huawei is developing an AI chip it believes can compete with Nvidia's H100. That's according to the Wall Street Journal. For a closer look at the chip sector, I want to bring in Brian Colello. He is Morningstar's equity strategist. Brian, great to speak with you this morning. Talk to me about this potential competition coming in from China, specifically Huawei here. To what extent is that a real headwind for Nvidia?
Oh, I think the headwind is in place, and I think it's pretty much game over for NVIDIA in China. I think the ban of the H20 was probably the final straw of NVIDIA being able to sell anything halfway decent into China, and I would expect that Huawei's products will probably be higher quality than the older products that NVIDIA has been shipping, or the H20, if not today, then at some point in the near future. So I do think NVIDIA's pretty much cut off, and I do think of Nvidia from here on out as much more of a developed market story. There's still plenty of growth in the US, Europe. So I'm much more focused on those markets at this point.
Brian, I had to check the transcript when I sat down in my new seat over here to make sure I heard you correctly. You are very bearish Nvidia China business specifically off the back of this news. What do you think that initiates for Nvidia? Do you think they potentially spin off the China business at some point, or do you think they just cut their losses and invest in other markets?
Well, I think they already have a $5.5 billion write-off, and we'll hear from them more in late May. So, it's possible maybe there's something they will be shipping, but I think the restrictions have cut the materiality of the China business in steps, and I think this H20 cut and the $5.5 billion write-off is as close to the final straw as I could think of. I think they just walk away and focus on the U.S.
And talk to me
as long as they can. I mean, if the restrictions get lifted, Nvidia would love to be back there, but I just don't think the U.S. Government will let them, quite frankly.
So then what does that mean for American investors, especially as we do head towards those Nvidia earnings? Do you think that there's still a bull case for this name in the short term?
Absolutely. I think Nvidia is still selling everything they can make on the Grace Blackwell side. There's still tremendous growth from the hyperscalers, Google, Microsoft, et cetera. We're seeing few signs, if any, that they're really slowing spending in 2025. It seems like they're buying all the Blackwells they can for this year because of the performance improvements. And we're still skeptical that U.S. companies are going to slow down their AI investments, even with the recession. AI is the future. It is certainly a race right now. And we think that spending continues in the short term. So I think Nvidia is set up. And now China could be a hit. So maybe we do see less earnings growth this year, less revenue growth, maybe even revenues down quarter over quarter because of the big China hit. We'll see on that. But everything else should be pretty good. And there's still a lot to be bullish about for the U.S. and AI in the future.
And just curious how you think about companies that announce U.S. investment plans. This morning, IBM becoming the latest with a $150 billion investment in the U.S. As you know, there's already a $500 billion proposed investment from Nvidia. Does that change how you feel about any of these stocks? Does it make you think, okay, well, maybe they'll get a carve out from the administration if they are playing ball with a domestic investment?
Yeah, so I do think that's the upside. So I think China has always been a risk, and if your prior question was about the short term and the hit to China. So that's the downside. I think that's why Nvidia has sold off. At least I think the risk reward is still good because of the upside that you're mentioning, all the investment that can still be done in the United States, thinking about Stargate and everything else. I also think from a, let's say, tariff side of thing in the U.S., that we're still in a race for AI. The U.S. wants to be in the lead in AI. So I think if Nvidia and its partners, these leading tech firms, were to come to the U.S. government and say, hey, we're being slowed down because of tariffs, I think those restrictions get replaced. So I would say Nvidia is really one of our top picks if you're looking for companies that have minimal tariff exposure from here. Again, I think the H20 cut already happened, but if you're looking from here on out, I think Nvidia is probably better off than some other chip makers in terms of future tariffs that might get hit on them.
So, Brian, let's end where we started on this Huawei news. Given that you are talking about how Nvidia is well positioned amid the tariff impact, they are cushioned to a degree. Do you think that this narrative that I've heard from a lot of other investors that China is going to start to outpace the U.S. when it comes to tech and specifically AI, is that narrative a little overblown in your view?
It's not overblown. I do think it's a risk. I mean, there is a very conscious decoupling of AI between the U.S. and China, and the U.S. restrictions have caused that. And I think from the start, the risk has always been, if you're cutting China off from U.S. products, is China going to go off and do something else? What if they do something better than what the U.S. can do? So I think that risk is still there. I wouldn't say that the Huawei products right now today signal that China is clearly better in AI, but it does continue to raise eyebrows that China might catch up faster than the U.S. government thought, and this is the consequence. The consequence of those actions. I think Nvidia is still going to drive innovation. I think they're still best of breed in the U.S., and I think the U.S. will be leading, but China has every incentive in the world to keep up and to be organized, to focus on Huawei. Like, they don't need to do it while satisfying investors, and that probably gives China at least a little bit of an advantage to keep close to the U.S. I think that's possible, yes.
So is U.S. tech dominance at risk in your view?
I don't think so. I mean, again, you're looking at Microsoft, Meta, Google, Amazon. I think those companies will still be just fine in AI. The foundational models, most of them are still, if you think about OpenAI and Anthropic, are U.S.-based companies. So I still think you're going to get plenty of innovation on the AI front in the U.S. But China's probably going to be close. I mean, Huawei's doing some impressive work. DeepSeek was certainly an impressive foundational model. There's large internet companies in China. So, on a broader scale, China is certainly a rival to the U.S. economically and technology-wise. And AI is just another piece where they're going to be close.
Brian, thank you so much. Appreciate your insights this morning. Coming up, we've got Apple earnings on deck. What to watch ahead of the results. That's next on Catalysts. Apple is set to report second quarter results on Thursday after the market close. Yahoo Finance's Dan Howley has a look at what we can expect. Hey, Dan.
Hey, Madison, that's right. We're looking for a lot of talk about tariffs, obviously, whether or not we're seeing iPhone growth and whether or not Apple Intelligence is driving anything meaningful as far as growth goes. And let's just kind of go over the numbers real quick. EPS is expected to come in at $1.62. That would be an improvement over the $1.53 that they had seen in Q2 last year. Revenue is supposed to come in at $94.2 billion. That would be an increase from $90.7 billion. That's all good and grand. But the big question is iPhone revenue. And so that's expected to come in at $45.6 billion. Now that would be a decline versus the $45.9 billion they had seen in Q2 last year. So where's that extra revenue come from if the iPhone's not selling as well? Well, analysts are expecting iPad, Mac, and wearables, services, home, HomePod, those kinds of products to increase while the iPhone decreases. Now, one of the interesting things to look at will be Greater China revenue. And according to analyst estimates, it's expected to come in at $16.8 billion. That would actually be an increase from the $16.3 billion in the same quarter last year. So it seems like China will do slightly better. This is according to estimates than what they had seen last year. That's after the drop from Q1 in China revenue that we had seen. So a better kind of outlook for overall Greater China revenue, which obviously an incredibly important market for Apple, but it's seemingly not lining up with what they're expecting from the iPhone. So it could be that the Greater China revenue increases as a result of consumers getting out there trying to get ahead of any potential issues related to the tariff situation. It could also be to do with sales that were going on over in China at the time. And I think one of the important things that we're going to be looking for is whether there's pull forward from consumers in the last quarter. In other words, whether or not consumers knew the tariffs were coming and decided, well, okay, let's go get an iPhone now so we don't have to potentially pay more. We should see more of that in Q3. If there's any at all, that's when you would really see that kind of shakeout. But I think it's something to definitely keep your eye on if you're going to be watching Apple.
So help me kind of put a headline to this, Dan. To what extent are we going to get clarity from this earnings print from Apple about the brunt of tariffs impacting its business?
Now, I don't think we're going to get very much, clear-cut answers. I think that, Apple is very diplomatic. Obviously, Tim Cook has a decent relationship with President Trump. So I don't think that they're going to say, look, tariffs are going to annihilate us or anything like that. I do think that there will be some probably hedging as far as the coming guidance goes, whether or not they'll dive into, where that issue will be, whether or not they'll talk about the, broader tariff plan or any kind of, critiques of that. I don't think that's going to happen. But we should get some insight as to the manufacturing processes that they may be taking, the steps they may be taking to offset any potential tariffs. So think moving production to India for U.S. users instead of China. But there's still a huge amount of production that comes out of China, so they can't, just pick up and move everything to India for U.S. users.
All right, Dan, thank you so much for joining us. Appreciate it. Apple, one of 4 Magnificent Seven members, set to report earnings this week, and Callie Cox is still with us to provide some more context. Callie, you were telling me about the specifics within each earnings print that investors can look at to suss out tariff impact. What are those?
Yeah, and Dan actually brought up a really good point. Companies aren't going to come out and say we're getting annihilated by tariffs. Look at our awful revenue numbers. you have to look for the hints, right? And right now, a lot of companies are talking about the quarter before us, the quarter when tariffs really started coming to the forefront and started rolling out under President Trump's administration. You're going to hear a lot in the management commentary around tariffs. And again, not outwardly bearish, bullish, anything like that, maybe on the margins, but you're going to hear little hints about, again, how Apple is changing production, how other hardware companies are, thinking through how tariffs will affect costs and revenues. So you have to be very careful, and I'd say probably listen to the earnings call more than you scan the earnings report. But when you look in the earnings report, look at the guidance and how guidance changes.
And when you think about tech specifically, to what extent do you think that Apple's results are a bellwether for the rest of the Mag 7 names?
Well, it's Apple. So, Apple's had its status for so long. I mean, back when I was a reporter, everybody watched Apple earnings. There was no question around that. So things have changed a little bit. I think Nvidia is an important bellwether here, especially with the AI story. But we're waiting a few more weeks for Nvidia. So right now, I think Apple is the one to watch, especially because it's a hardware company.
Yeah.
It produces a lot of its products outside of the U.S. It's moved out of China a little bit in the past, but at the same time, it is very globally exposed. So that's the place to look for clues.
Yeah, and we'll also have Amazon results coming up this Thursday as well, which will also give us insight into some of that consumer goods impact as well. So that should be really important and interesting to monitor. Callie, thank you so much. Thank you for joining us for the hour. Really appreciate Callie Cox, again, with Ritholtz Wealth Management as their Chief Market Strategist, joining us for the hour. Thank you. Coming up, we got Wealth. It's dedicated to all of your personal finance needs. Our very own Brad Smith. He's going to have you for the next hour, so keep it here for more.